Brendan, could you explain to us the regulation about raising capital? Now, can anyone raise capital from whomever they wish for whatever their business idea is here in Canada?
So the short answer to the question is no. Now, of course, obviously, as with lawyers, there's no such thing as a real short answer. So unlike in the US, we have a fairly complex province by province regulatory system for securities offerings, for public offerings, for raising money, that sort of thing. And while we have some level of national guidance for them, a lot of the regulation is province by province. So the short answer is, as a general rule, the starting point is always that a prospectus is required for any securities offering. And so that when you think of a prospectus, think of an offering document that would be issued by, you know, Facebook when it does an IPO, or some other large organization when it intends to be publicly listed. Now, the exception to that is if you can find an exemption. And there are a number of exemptions that are frequently used particularly in the real estate market, and particularly in the cross-border real estate market. And the two most prevalent exemptions, or the three most prevalent exemptions, I should say, are, in the first hand, doing an offering under an offering memorandum. And an offering memorandum is, we refer to it as prospectus light. And it's basically a less cumbersome document, generally shorter. Really what it does is it goes through the intention of the offering, what the purpose of the fundraising is for, the ownership structure, various risk factors, and other things like that. And really kind of walks an investor through the various moving pieces in any sort of real estate offering or securities attached to a real estate offering. The second exemption is what we refer to as the accredited investor exemption. Now, accredited investor is a specified term under one of the national instruments published by the Canadian Securities Regulator. And in essence, think of it as meaning a high net worth individual, or a company or a family trust that has significant financial and non-financial assets. And really the intention there is, the idea is supposed to be that in essence, you know, high net worth individuals, family trusts with significant assets under management, that sort of thing, are typically more sophisticated investors. They may have a management committee, they may have other oversight, but certainly that they're typically, you know, you tend to find a lot of, for example, lawyers who are investing in deals who are subscribing under the accredited investor exemption, you know, tend to have fairly high net worths, tend to be knowledgeable about securities offerings, risk factors, things like that. So that's the second exemption. Okay. And then the third exemption that's typically relied on in this case is a minimum exemption requirement. And this is sort of a bit of an odd creature of Canadian securities law, but essentially it says if you're investing over a minimum amount of $150,000, again, in that case, no prospectus is required. This is a little bit more murky, and it's also an exemption that's not typically relied on because it comes with a lot of securities regulatory filing requirements that are typically attached to prospectus offerings that are quite cumbersome, costly, that sort of thing. So typically we try to stay away from those two. So the two most common ones are the accredited investor and the offering memorandum. The big advantage of the offering memorandum is it opens up the offering to a much wider pool of investors. So the investors who might not qualify as accredited for very specific reasons are still able to invest in deals under the offering memorandum exemption, and issuers are authorized to actually issue to sell securities under the offering memorandum exemption to essentially to any member of the public who receives the offering memorandum, and that makes it a very attractive tool for a lot of issuers because it does require less sort of cumbersome disclosure requirements, while at the same time disclosing in a very fulsome and sort of thorough manner to the investors, what various risk factors are, what the ownership structure is, these types of things, who's going to be managing the investments, that sort of thing. So So it's a very good document that way, in that it gives investors a very good understanding of the prospective investment and that sort of, and, you know, allows them to make an informed decision. So.